Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss the impact of stock market concentration on trading strategies.
Hello everyone, my name is Radovan Vojtko, I'm CEO and the head of research at Quantpedia. Today we will discuss what's the impact of stock market concentration. So it means what's the impact of concentration of market capitalization among the few very big stocks like Apple, Alphabet, Microsoft, etc. on the performance of some other factor strategies like size factor in equities. I would say that most of you agree with me that the stock market at the moment is highly concentrated. A lot of the performance of the stock market is caused because there are some extremely large companies that perform very well. They are sometimes called Magnificent Seven, so that's the current name for those companies. Those companies are usually Alphabet, Amazon, Apple, Meta, or Facebook in the past, Microsoft, Nvidia, and Tesla. That's the current name. In the past, they were known as FANG, F-A-A-N-G stocks. It was mainly Meta, or previously Facebook, Amazon, Apple, Netflix, Alphabet, and previously known as Google. So those are the companies that have a very strong balance sheet, are usually tech stocks. They grow very fast and they are a significant part of the market capitalization of the US stocks. Market at the moment is significantly concentrated among a few extremely large companies. But the question is that the exception or the rule over the history? And what's the impact of this concentration on the performance of some factors? And in this case, we are checking the size premium. So what's the interesting paper that we can use is a paper written by Emery and Coeter in 2023. And it shows exactly the answer to our question. So what's the impact of the concentration of the stocks on size premium? Now, what is the most interesting chart in our opinion is the chart of figure number 1. It shows the stock market concentration over the history. So we can see current years 2020, 2023, etc. There is high concentration, so it means there is significant market capitalization concentrated in a few large cap stocks. The position as it is at the moment was in the year 1970s or 60s, so we are closing to the 1970s or 60s, and we are significantly more concentrated than in 2000 at the top of the tech bubble. But the current situation is not an exception, because especially in the 60s and 30s and 40s, the market was concentrated even more than at the moment. So we are not used to that situation because last 20 or 30 years were significantly different. So the stock market concentration was smaller. But we are getting into the situation that was common in 60s or 70s. The question is, what is the impact of that stock market concentration when the market capitalization or market performance is significantly concentrated among few large cap stocks? Those stocks that are smaller one or very small, they are not very interesting to investors because there are so many news going on about few large cap stocks. Very hard for small stocks and their performance is when the situation changes. So when we move from the small concentration to high concentration. So that's what happened after 2020, and the size premium went significantly down. But on the other hand, when we have a change from the higher concentration to lower concentration, the size factor significantly outperformed. The size factor or the small stocks, they do not outperform the large cap stocks always. There's ebb and flow between outperformance and underperformance. So it's important to have the trading strategy, and important to have some framework in which we can time the market, time when it's better to be in the large cap stocks and when it's better to be in the small cap stocks. There are a lot of trading strategies that are related to this small cap or to size premium. The size premium is just another factor. So there are a lot of strategies that are trying to time the small cap factor, etc. I will show you just one. It's called the timing the small cap effect. The way how we can time the real life portfolio. So by going the long Russell 2000 and shorting S&P 500 is using the past 12-month return as a trading indicator. We can hold the small minus big factor portfolio only if the past 12-month return is a negative. In this case, we are betting on a reversal, and the performance is significantly more predictable than just holding the size premium all of the time. That's not just the one way how to approach timing of the small size or size factor. There are also other strategies. The main takeaway from the research paper is that the situation changes. So we can have a situation where there is a high concentration, and we can have a situation when there is low concentration. And when we move in the market from low concentration to high or from high to low, that's the time when the small size stocks can outperform or underperform. So it's important to pay attention to the concentration. It's important to have some systematic way how to trade or time the size factor. I hope that you like this very quick introduction into the size factor and how to time the size factor. The links are in the description. Once again, I really recommend you to read the original paper by Mr. Emery and Mr. Kretker, the size premium in a granular economy. And of course, if you are looking for some strategies how to time the size factor, we are more than happy to provide you some of the strategies in our Quantpedia database. So I hope that you liked the video. I hope that you will join me in the next one. Have a nice day and happy trading.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.